Fed's Beige Book and a piece from Wells Fargo put together give us a poopy doopy picture. Now, what I've never seen before is one of these research analysts looking at data and then saying, hey, look, we got to talk about confirmation bias and how we don't want to look for things that align with a bearish or bullish thesis. That said, this data that Wells talks about here, not great. In fact, they say it's the first time in 60 years that we're seeing this recessionary red flag fire. So let's go through this in detail, and then we'll hit the Fed Beige Book. I do want to mention that at the same time this was published, UBS did say that so far S&P 500 EPS is still resilient. I made a little note, Empire Manufacturing was good. We should expect to see a downshift in some of the growth rates of stocks earnings that we've seen. But so far, the data is still healthy. Layoffs are stable. And of the 22 S&P 500 companies that have already reported, 68% of them have beat on sales and EPS, just shy of historic estimates. Though they do say, hey, a little early to tell. Okay, this is fine. Hey, yeah, there are risks. You know, are we going to have a breather later this year is what they talk about. They do say, this is the bullish piece, okay? The bullish piece says over the past 50 years, valuations have only been higher during the dot-com bubble in the late 1990s, in a brief period in the aftermath of the COVID pandemic when interest rates were rock bottom and earnings growth was surging. In other words, even the bullish piece is like, yeah, guys, valuations are a little cooked up right now, okay? Just saying. These are the bullish folks at UBS. Now we got to look at the poopy doopy one, and I'm going to give a shout out to our homies over here, okay? If you know Tim and Shannon, let them know your boy Kevin said they did a great job. I actually think they did a fantastic job on this piece, and I think they were very reasoned with their research. And even though I hate Wells Fargo, I basically hate all the big banks. I think the big banks are kind of a scam. But, you know, it's really a topic for a different video. I have to say this piece was good. All right, ready? You can't see me. My time is now. All right, you ready for this? The time is now. The details of consumer spending and retail inventory data already reveal some concrete evidence that tariffs are undeniably hitting consumers or impacting consumers. When it comes to discretionary service outlays, households are cutting back. This becomes very important in a moment. You'll see this in just a smidge here. In terms of goods spending, some key tariff-linked items show a measurable pull forward, followed by an air pocket in the months since. Stockpiling by retailers has mitigated the inflation impact for many goods when pre-tariff inventories have been drawn down, or when those inventories have been drawn down, the cost pass-through will be stark. So let's just clarify this for a moment. In English, what they're saying is, hey, yo, Americans buying stuff like services, they's cutting back. Less of that. Goods, they bought lots right before tariffs. But now they cut back on that too. And the businesses, well, they're just subsisting off the inventory buildup. And things about to hit the pooper duper. But wait a minute, Kevin, you said there was some data in this about some really bad 60-year data. What is that? Yes. Coming up. Right here. Okay. It is never quite rang true that consumer spending was completely unfazed by a sudden implementation of tariffs. This mirage, the MAGA mirage. That's a good line, actually. I just made that up. The MAGA mirage was sustained by initial estimates of GDP growth that pegged the pace of inflation-adjusted Q1 consumer spending at 1.8%. That's 3 times faster than what it turned out to be at just 0.5%. In other words, we overestimated consumer spending by 3x, more than 3x. We more than 3x overestimated consumer spending. This happened in 2007 as well, when GDP was way overestimated and later revised down to negative substantially. Okay? The overshoot was even more pronounced with services spending, which was initially reported to be growing at a 2.4% pace before being reduced down to just 0.6. That's a 4x miss after revision, which is when fewer people are paying attention. The downward revisions were not exactly shocking to anyone struggling to reconcile strong spending against the sharp deterioration in various measures of consumer confidence. The lackluster spending has not been limited just to the first quarter, though. With the first 2 months of data now on hand for the second quarter, that would be April and May, there is a clear warning sign for consumer spending that has gone largely overlooked. Clear warning sign that households are reducing their discretionary spending. Early in the cycle, we noted that in more than 60 years, there has never been a recession without real discretionary spending falling on a year-over-year basis. Until recently, the worst that could be said of discretionary spending is that it was growing at a slower pace. Discretionary spending purchases slipped in the first quarter, while estimated discretion was still up over 1.5%. So in other words, hey, we had these strong estimates, and then everybody's kind of like, all right, things were just a little bit slower, but it's still growing. Well, that might be true for discretionary goods spending, but unfortunately, discretionary services spending has had some major issues. Look at this. Discretionary services spending has not held up, whereas goods spending has held up. On a year-over-year basis, discretionary service spending is down 0.3% through May. That is admittedly a modest decline, but what makes it scary is that in 60 plus years, the measure has only declined either during or immediately after recessions. Okay. Now, what can we do to potentially balance this bearishness? Because that sounds bad, right? So what balances this out? Sounds bad, but if, and this is kind of what we see with, some of the other Wall Street commentary around this. But what if people slowed, let's do this. People cut their services spending. Okay, let's put this somewhere, or let's just make this smaller. You know what? Oh, I have nowhere to put this. There we go. Sounds bad, but what if people cut their services spending because they wanted to pull forward spending on a new car or new set of appliances? In that case, consumer goods would hold up and services spending would decline. So in other words, this time could be different is the argument. So we should make a note of that. AKA, maybe this time is different, which are the most dangerous words in finance because it's usually not different. But hey, it's kind of a reasonable argument. I know a lot of people myself who decided, hey, I'm going to buy a car or I'm going to buy appliances or whatever because I'm going to get in before tariffs. All right. So I'll make a note here, see below. So then they get into saying, if we are hoping for a way to disqualify this recession signal, we might point out that the lost. Oh yeah, this is a similar argument. So we talked about this morning as well, but it's a similar argument. We might point out to the lost wallet share at a time when households were prioritizing goods. Fine. Of the 8 major, so then we look for additional context. Of the 8 major spending categories, just 3 of them accounted for 63 cents of every dollar spent. So in other words, just 3 categories out of 8 represent, so what is that? 3 divided by 8. 37% represents about 63%. Categories rep 63% spend, which basically imply that these 3 categories are pretty large. Food services is the largest of that with a 28% share, recreational transportation. So those are the 3 large ones. After accounting for inflation, households are spending just 0.9% more when they go out to eat compared to a year ago. That's after inflation, right? Remember, Brian Moynihan gave us the the non-inflation adjusted numbers. All right. After accounting for inflation, households are spending just 0.9% more when they go out to eat compared to a year ago. Largest category of discretionary spend is increasing, but only incrementally. Recreational services were up 0.2%. Transportation spending down 1.1% over the past year, with this being auto maintenance, taxi and ride sharing, and the biggest decline of all, air travel. The fact that households are putting off auto repair, taking fewer Uber rides, and cutting back or eliminating air travel points to stretched household budgets. Okay, let's write that down. So this is important. Wells argues this is not an issue of pull forward for goods, but rather a warning of very stretched household budgets thanks to Ubers, car repairs, and travel plummeting, basically. Or I shouldn't say plummeting, I should just say falling. All right. Then they say consumers pulled forward some vehicle purchases. Vehicle sales rose at a level not sustained since prior to the pandemic. Consumer prices of major household appliances rose 4.3% in May, marking the second highest monthly gain on record after COVID, and the third highest gain was in 2018 after Trump Tariffs 1.0. Trump Tariff 1.0 also pulled forward appliance demand. Also very logical, right? But while we've seen isolated potential tariff effects like higher appliance prices, auto prices remain tame and inflation remains in check. Part of the reason we haven't seen this pass through yet is because of inventories. More inventory on hand means firms can still mitigate the initial pass through of higher prices stemming from tariffs, particularly if sales slow. The on and off again trade policy could also be a mitigating factor for now. If you look for trouble, you'll find it. And this is where they give a caution about confirmation bias. They say, we're doing our best not to, but the downward revisions to consumer spending numbers this year have justified a degree of skepticism. Consumer spending is simply not as sturdy as we previously thought it was, or even as it was reported to be. Right, because we saw a 3 to 4x miss. Huge, okay? Consumer spending is simply not as sturdy as we previously thought, and it may still be true that we would prevent a recession, but consumers have shifted in the wake of tariffs. Consumers are undeniably cutting back. And when the pre-tariff inventories are drawn down, the cost pass-through will be stark. Okay, AKA consumers are pulling back, and when the poop hits the fan, it's going to suck, and it's coming. We've already seen the start of the coming at my OnlyFans. Okay, no, at the PPI and CPI reports and the goodies at the Meet Kevin Alpha report. Use coupon code Mr. Too Late to make sure you're part of the Alpha report. Let's see how Open Door is going. This has been one of our big calls the last couple of weeks here, and it's just been straight up 37% on the day. Let's go. So use coupon code Mr. Too Late. You pay once and you're in it forever. Forever. Which is kind of cool. Okay, but so now that's Wells Fargo, but how does that reconcile with the Fed Beige Book, right? Because if we go over here to the Fed Beige Book, what we really have is a Beige Book that talks about this stability and like modest growth to slight declines. But I want you to see where the declines are. Look at this. This actually echoes what Wells Fargo says. And this is data that goes through July 7th. So that's why they say economic activity late May through July 7th when they say early. I think that extra context is useful. Non-auto consumer spending declined in most districts, softening slightly overall. Okay, construction activity also slowed. I think this is a good thing for a house hack because it's then cheaper for us to build our accessory dwelling units, or eventually, we're working on developing lots. In the future, we'll do little tracts. So we're really excited about kind of competing with like the Lennars or the likes in the future. depending obviously on how our AI launch goes, because if that little side project takes over and makes lots of money, well, then we'll just throw more into real estate. It's just really like an accelerant to what we're doing. But anyway, labor markets. Hey, you can learn more about HouseHack at househack.com. We got a fund open to non-accredited investors. You could get a 5% yield while you're in it through conversion, and then you get all upside in the stock. So it's a cool preferred round. You can learn more about it at househack.com. Anyway, they say, okay, every district has a little bit of a different POV on what's going on here on labor. But I want you to see this theme. Boston, guardedly optimistic. New York, declines modestly. Philadelphia declines modestly. Cleveland, flat. Richmond, moderately weaker. Modest growth in consumer spending. And then at Atlanta, consumer spending softened. Slight increase in Chicago. Employment levels unchanged. Economic activity unchanged in St. Louis. Flat in Minneapolis. Unchanged in Kansas. Dallas up slightly. San Francisco largely stable. So what you're really finding is the market's sort of like in this stasis right now. We're just sort of floating like, oh my gosh, there's so much Trump news every day. Like, when are we going to get the final clarity? And in the meantime, we're just going to burn through our inventories and we're going to survive, right? We're going to be okay, right? That's one of the reasons I think we haven't seen the spike in layoffs yet, which is good, but Wells Fargo's right. Like, the flip on the consumer is starting to happen. Even the Fed Beige Book talks about it, which came out after the Wells piece here. But anywho, and when we talk about layoffs, in some markets, you see, in the Boston markets, for example, you see no indications that firms are planning a bunch of layoffs. Again, people are in stasis because they're not planning a bunch of layoffs, but they're also not planning significant hiring. Over here, this is in the New York district, you have layoffs remained limited in the region. Some businesses reported postponing hiring and layoff decisions until uncertainty resolves. Stasis. Some had canceled plans to add staff due to low demand, and a few had instituted layoffs in Chicago. Then we have here, some contacts reported layoffs due to federal government spending cuts. Others cited weak demand. Although some energy contacts said, hey, fewer layoffs because oil prices went up, but that's not highly sustainable because oil prices plummet as consumer spending weakens, so that might not last very long. Oil prices may have popped up heavily because of the Iran stuff, is my opinion. Employment levels slightly lower on net. Employers using attrition and layoffs to reduce headcounts. That's in San Francisco. We've got manufacturing and entertainment sectors noting layoffs in California. And then we have, although reports were limited, this is the national, right? They were somewhat more common among manufacturers, and many wanted to postpone those layoff decisions until we got more. This is back to sort of the nationwide summary. So, yeah, like what do you take from this? Because really, if you put all this together, what you have is you've got UBS saying, bro, valuations are at 50-year highs, that we haven't seen until the heights of the dot-com bubble and the immediate aftermath of the COVID pandemic. You've got Wells Fargo saying the data is literally in your face. We have not seen these declines in data in 60 years. And the Federal Reserve isn't telling you that the economy is booming like Trump says it's booming. The Fed's actually saying everybody's sort of like on this precipice. Like, are we going to run or are we going to crash? Like, what are we doing here? Are we going to go run the marathon or are we going to go to bed? Okay, it's fine. We're doing a course member marathon. When are we doing that? Yeah, we're doing a course member marathon in New York towards the end of August, half marathon. I'm too much of a weenie to do a full marathon. Although I've never done even a half marathon, so that's going to be interesting. But anyway, that'll be cool. But I mean, it's kind of like that. It's like, hey, Lauren, are we gonna go on a run or should I just go take a nap? Like who cares? Like just tell me which way we're gonna go. Okay, we'll lie down or go run, put the shoes on. And that kind of is what the economy feels like. That's why, with HouseHack, we're positioned like, all right, we can go either way. You tell us, economy, we gonna run or we gonna go for a nap? We're good either way. We're going to make money in either scenario. We'll just kind of wait and see which scenario it's going to be. Learn more at househack.com. And then of course on a daily basis, you can kind of get my POV on what short-term trade ideas are or perspectives. Hopefully you can make lots of money and you make all your money back and way more. Obviously, I can't guarantee it because ultimately you're the one who pulls the trigger on how to do stuff. But hopefully you could use those insights if you join in the Meet Kevin Alpha report. You can get it through the Meet Kevin app as well, which is really convenient. A lot of people seem to like that.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.